has certainly been filled with discussions around the numerous transitions that are taking shape in global gas markets and the key players that are instituting those changes. I can't think of a more fitting keynote to end our day with. Under Patrick Pouyanné's leadership over the past 4 years, Total has been at the forefront of a big energy model, shifting the French major's core oil and gas portfolio increasingly toward gas, while also building out an integrated strategy that includes investments in renewables and power. As we draw Oil and Money's Gas Day to a close, we've asked Patrick to share his thoughts on why that strategy is seen as the most effective way to position an oil major for the low-carbon energy transition and the opportunities and challenges that it presents. So with that, please join me in welcoming Patrick.
Good afternoon, everybody. It's always a pleasure to come to this conference. And today I've even the honor to deliver 2 speeches, one to you then, and then after that to Bob Dudley, who is the recipient of the award. So speaking about gas, why are we investing more in natural gas? I think I had a long speech, but I just put a few notes on the paper, so it will be lighter. The fundamental aspect of it is driven by markets, evolution of the market. You know, when you think to the future of an oil and gas company, you have to look to where the demand will be, because the ambition is to continue to grow. And obviously, there are 2 markets which are growing quicker than the rest of the energy. One is natural gas, providing that there are some conditions. And among natural gas, there is the LNG. LNG is growing by, we say 5% for the coming 10, 15 years. But the last 3 years, it was 10% per year. And we'll come back on it, mainly driven, of course, by the Chinese demand and emerging countries' demand. But you have there, with LNG, a very growing market, and which is, by the way, fitting very well with the business model of major company, because it's capitalistic. And so, and the level playing field, I would say, of course, there is companies like QP. I think Saad Al-Kaabi was here today. But the rest of the competition is major companies. The other market which is growing very quickly is electricity. In all the scenarios, electricity is growing by more than 2%, 2.5%. You take the 2 degrees, the 3 degrees, the 5 degrees, and inside electricity, you have in particular what we call low-carbon electricity, which is electricity either produced from natural gas or from renewables, which is growing, which is will double, at least double between today and 2040. So when you think to the future and you try to identify the area of growth, you have identified 2 good markets for a company like Total. That's the main driver, let's be clear. Of course, there is a second way to look at it, is integration of the value chain. When, you know, in oil, we have proven that the best way to be resilient to the volatility of the price is to be integrated along the full value chain, from production to refining, petrochemicals, to distribution. In natural gas, we want to do the same. We want to be not only producer, LNG producer, like we were before, but we want also to be able to trade it, to market it, to distribute it. And the value chain of natural gas is leading us to electricity, in fact, because it's one of the use. And frankly, manufacturing, operating or building a gas-fired power plant is not very different. It's not very complex for people who are able to run and to operate and build refineries. And when we market gas, by the way, and it's the experience of Total, when we want to market natural gas in the B2B segment, generally the customers, they want also electricity. They want one provider. These were a lot, so integration of value chain is a second argument to try to continue to develop that business. The third argument, but it's back to the market, is of course that when we look to our companies, a lot of investors, because they open the newspaper in the morning, where they see that oil is no more required in 10 years, you know, they think that a lot of investors, which are not the specialist one, are asking, why should I invest in these companies? So we need to offer them a future, a vision, a strategy. Where do we go? And of course, we are all convinced, and I'm fully convinced, let's be clear, don't misunderstand me, that the world will require oil, a lot of oil, in 2040, 2050. The world will require more natural gas. But it's also true that again, we need to convince them, and the strategy is to tell them, yes, there is a future, which is to enlarge our portfolio to what we call low-carbon electricity. It's not a strategy of renewables. Maybe there is a shift in this pitch, let's be clear. It's fundamentally to deliver electricity, and low-carbon electricity means for us producing it from natural gas or from renewables, trading it, and we have the experience of that, and marketing it either to B2B or B2C. And okay, I know that there are some debates, but we have been opportunistic, and today we have, since last week, 4 million customers in Europe, in B2C, in residential customers, and we have only 350 people to manage 4 million customers. It's a very disruptive business model based on digital. So we do like Uber in the electricity. I'm not, don't call Total the Uber of electricity, but we are disruptive. And it's why I think we are not at all the ambition to be a utility. We have the ambition, because we will never, let's be clear, invest in regulated networks. We just solve them, all of them. So what we want to do in the European field, because it's a free market, is to intervene where it is possible to be efficient, which is on the production stage, on the trading, and on the marketing, but in a low-cost business model. The other beauty of it is that we have just acquired in 1 year 5 or 6 gas-fired power plants. When we pay them today in the European market, you pay them a fourth of their value if we had to build them. So it's a unique opportunity to try to develop a portfolio, which for us, and the target of profitability, to be clear, is at least 10%. And I hope that my E&P division will do it that quickly without needing $80 per barrel. So it's a question of giving a future, investing in growing market, having the ambition to be responsible and to contribute positively to this climate change challenge at our limit, because of course it could impact the market, and because fundamentally it offers us some new opportunities. Coming back on the other part, which is the most important among the moves we have done, is the LNG market, where obviously it's probably for me among the various acquisitions which have been done by the group, the boldest one and the most fundamental one, because by combining the portfolio of Total and of ENGIE, we have put together the number 2 in this LNG market with almost 40 million tons of LNG to manage, 10% of the world market. We intend to keep this 10%, which means so that we have to continue to grow on the production side and on the marketing side. Fundamentally, this is important because we believe and that this is a market, and I think that probably some speakers before me explained that, which is evolving. We think that more and more, because of the US LNG, because of fundamentally the technologies, you have many more countries with FSRUs, which we can have access to more customers, more supply sources around the world. And so we see an evolution of this LNG market going step by step towards, I would say, oil market, much more liquids. By the way, it's not by hazard that the trading houses are entering into the market. And it's fundamental, all these moves, because we need, if we want to really achieve the potential, the full potential of natural gas to find its market, to find customers, we need to lower the cost of the full LNG chain. Today, it's expensive. And what is in particular expensive is all the logistics of it. When you sell LNG from Europe to Asia, out of $7.5 per million BTU, you can have a third, which is just transportation and logistics. Being able, when you see today that you have LNG tankers going from Norway to China, while Qatar is sending LNG tanker from Qatar to Poland, maybe Norway could go to Poland and Qatar to China, just an example. All this optimization today is not really done. And we need players who are behaving more as portfolio managers and able to, and it's linked also to an evolution of the market going from long-term contracts to more spot and long-term contracts. But this flexibility will be for the benefit of the customers, because if we are able to do that, we will drive the cost down, and I think it's fundamental. LNG is also makes also sense because we can develop new markets with LNG. And during the last year, we have been able to convince one big shipping company to take LNG as a fuel for its shipping, big container ships between Europe and Asia coming back. We have to invest in some infrastructure, but it's clearly clean and economically, since it makes sense. We have also decided to invest in a company in the US, which is a leader of the natural gas for trucks, called Clean Energy, 500 stations. There, of course, there are two drivers. The disconnect between the gas price and the oil price, which today is better, by the way. The second is to convince, I would say, truck companies to acquire this equipment, and we need to subsidize them. But we think that we have an extensive strategy, which is to try to develop the use of natural gas along the full value chain, including down to the customers. So these are the reasons fundamental why we do all these moves, and I will be happy to answer the question. It's the markets offer growth. We think it makes a lot of sense from an integration of the value chain. And so it's a way to be resilient when there are volatility on the commodity price. We think that this type of business fits very well with the business model of a major company. It's a way to leverage our balance sheet in a nice way. And last but not least, it's fitting well with the fact that our ambition is to become a responsible energy major. And so integrating climate change challenge into our strategy, but not in a defensive way, but in an offensive way, because it offers us opportunities. Thank you.
Okay, just a couple of follow-up questions on the points that you raised. I mean, part of the investments that you are making in integrating your gas business is to help ensure that that future demand growth is in emerging markets. And I'm curious, how far do you feel that you need to go as a company to make those investments versus just letting the market forces kind of drive the rate of growth?
You know, you have to make, again, fundamentally, the natural gas is more expensive than coal. And so the question is, how do you convince Myanmar or Vietnam to shift from coal to natural gas? When you have all the Asian companies which are coming to them, or the Chinese and even Japanese, to tell them we have plenty of financing, do some coal-fired power. This is a real target. If you just go to them, I have some LNG and you have to do the job, you know you will never manage to convince them. So that means that in Myanmar today, yes, we are obliged, if we want to create a market, to also take care of what could be the power plant, because at the end, what they want in the Myanmar government, it wants electricity. It doesn't want natural gas, you know. They want electricity. So it's true that we could be led to enter, not alone again, with other partners, because we don't consider that we need to control all the chain. We need to be clear to create this type of market. We face exactly the same situation today in Ivory Coast, where unfortunately, by the way, we have to face the competition of a coal-fired power plant financed by China against gas, natural gas that we could bring. And I see that Europe wants to have a very aggressive policy towards Africa, but it seems that China is more efficient for the time being. So yes, we can be. Again, it's not a must. At the end, what we want is to be able to market our natural gas, but we have to be pragmatic. We need also to help these countries to invest also in electricity. Mm-hmm.
Well, earlier this week we heard from the IPCC in a pretty kind of bleak picture of the direction of climate change and the steps that will be needed to take to kind of rein in some of its more devastating effects. And we heard a lot today about the policies that would be needed to get us there. But I'm wondering, at what point does the industry need to do more, regardless of whether the policies come first? And I'm thinking, you know, what about a collective stance on zeroing out your net emissions or investing what it takes to make CCS work?
I think the industry, we don't have to wait for policies. Mm-hmm. We are today considered in the world as being part of the problem. So if we don't act ourselves, we will never manage to convince the policy. And we cannot just say, up to you to decide the policies. We are big corporations, and this is why, by the way, we have created this club, which is called the Oil and Gas Climate Initiative. It's where we were 4, 5, 6. We just welcomed 3 large US companies, which is a proof that it's very important. It's quite efficient. We have taken some decisions voluntary on minimizing the methane emissions of all our upstream chain. which have been very welcome. We don't need a policy to do that. You know, we have to assume the fact that we have a size and a responsibility, and that the society is waiting that from us. So let's be more offensive. And when we are together, it's better. When we are alone individually, people think he says that because it's his interest. Of course, it's my interest if I invest in something. It's not just to be, it's because I believe we can make a good business. Mm-hmm. But when we are together, and I think we are collectively, and because that means that we are creating a level playing field between us. So it's encouraging us to promote and to be more proactive. So I think if we wait, by the way, at the end, if we wait for the government to solve the issue, they will not solve it. You know, I'm not sure we will solve it, but at least I'm sure that, and the oil and gas industry has a lot of financing, engineering, technology. So we have in-house everything we can do to be considered as a real player. And the last event of the OGCI took place in New York. There was a meeting with the Deputy General Secretary of the United Nations. And we asked them, why don't you recognize us as being a counterpart, you know? Why? Because we are just oil and gas and we should not, we have a pushback against oil and gas? No, it's not normal. And I think the fact that we are proactive is considered more and more as something positive. So we have to take our future into our hands. Otherwise, you know, at the end, they will just ask us, we need to tax you, and you will, plenty of bad ideas. Mm-hmm.
Well, as you push further into gas and power, does it impact how you start to think about your upstream gas investments? Like, for instance, would you maybe reconsider the size of your investments in U.S. shale gas if you were to continue investing in the downstream side in the country?
That's very clear. You know, we just became shareholder of Cameron LNG. First retrain, we want to expand the plant together with Sempra, and the strategy will be obviously to match by our production, not the molecules will not physically go to the plant. It's just a question of edging the system, you know. Because if I'm just investing in the LNG plant, if the gas price in the US is going up to $4 per million BTU, obviously I will have less profitability. Mm-hmm. If I am managing myself, my own production, and I'm able, like today, to produce my gas at $1.5 per million BTU in the Barnett Shales, I'm fine. If I'm losing on one side, I will make money on the other side. So we don't want to be long shale gas, but for sure not. But you know, by the way, our production today in Barnett Shale is fitting with more or less our share of 5 trains in Cameron LNG. So we have it. But that we will clearly, for me, it's obvious that you have to edge. It's part of the integrated strategy we have, but it's a question just of economic resilience. And frankly, if you want to acquire some properties in the US to make some shale gas, it's for free. So it's not very complex. You have many sellers, more than buyers.
That's very true. Well, just a broader kind of geopolitical risk question. I mean, certainly it's nothing new for your industry, it's nothing new for your company, but you have been more willing than some of your peers to continue to increase your investments in the Middle East at a time when tensions are running pretty high. And last year, you said that you're comfortable with these risks because you see yourself as an Emirati in Abu Dhabi and a Qatari in Qatar. But what do
Saudi in Saudi Arabia yesterday, you know?
But yes, but what do you do when others don't allow you to make such clean distinctions? Like the US is not allowing you to be Iranians in Iran.
That's the rule of the law, you know, there is nothing to do. But, I mean, I cannot work in Iran because the US imposed sanctions which are absolutely not compatible with the business of a company like Total. So it was very clear since the beginning. There is no surprise. I mean, there is no surprise, let's be clear, for the Iranian government authorities because we always said that. Mm-hmm. So, I mean, again, I don't know if the decision is right or wrong. It's just that we have to take into account the political decision and then to act. Mm-hmm. But again, I have no regret, let's be clear. And if there is an opening tomorrow, we'll come back, you know, and we are a little stubborn. The earth is round, you know. Yeah. So that's it. But you know, we are quite agile in Total. Yesterday evening or this morning, I was meeting the Crown Prince in Saudi Arabia. We welcome my investment in Saudi Arabia. So you know, we are agile and we go quickly. Mm-hmm. And he didn't speak to me about Qatar, neither on Abu Dhabi, you know.
No, for sure. Well, Total was certainly among...
You know, at the end, what counts for us is that we invest in their country.
Yeah.
And you know, yesterday, we have announced that we'll invest $5 billion, $9 billion together, but $5 billion total in Saudi Aramco. That's a real investment. at a time where foreign direct investment in the Middle East is going down, it's a good news that a large corporation like Total is investing this amount of money. So this is the way also that we are seen as, and they always welcome investors, you know.
Well, I mean, to that point, we heard earlier that with the Qatari LNG expansion, that it is certainly expected that interested parties bring something to the table. So what's your pitch? What do you offer that your
I will not say that to my competitors who are in the room, you know. I think they are all afraid we could be too strong there, you know. No, but to be clear, first we have a strong established position. We know Qatar, it's one of the, I would say, the big foot of Total. They know very well the relationships are excellent, which is, of course, an asset, you know. It's better when you have established long relationships. After that, you know, in the Middle East, let's be clear, relationships count, but the offer will count as well. And for me, for the time being, I suspect that Saad Al-Kaabi could be quite smart to organize the tenders, you know, to obtain the best value for the country. So I'm not worried for that. And so we'll wait. For the time being, we don't know the terms. So I know, of course, Qatar wants to invest abroad. They have invested with Total abroad in Africa. You know, we have offered them some opportunities. But what I'm sure that at the end, it will be a matter of what are the terms we are offered on the plants in Qatar, and then we'll see the competition, you know. I think in the last 3 years, we have demonstrated that we understand the way that the national companies in the Middle East are thinking, and in Abu Dhabi, on Al Shane in Qatar. So I'm not, again, of course, it's an obvious business that we would like to participate. But, you know, each time that Saad is adding another train, it gives more chance to the competition, you know, to be part of it.
Very true. Well, we have a few more minutes, and I want to make sure we can take at least 1 or 2 questions from the audience. So there's a few over there, I see.
Yes, Philippe Ross, Energy Intelligence. I have a question about OGCI. You said that when investors and analysts read the newspaper, they see that oil is going to be dead in 10 years and they need to be told a story that it's not true and that they need to keep investing in oil companies. When I read comments about OGCI initiatives in the press, I have the feeling when investors read those comments, it's what the OGCI is doing is not enough for them to be convinced that the oil companies are doing enough about CCS, about green technology, and so on.
Yeah, I mean, OGCI is a joint platform. We are always criticized when we do something. But it's better to do something rather than to do nothing. There is a lot of strange debate about is it enough to put $100 million per year on 10 years per company. The idea was not, of course we could put more. The idea is to spend smartly $1 billion, which is the large amount, or $1.3 billion with the 3 newcomers, by the way. And again, this debate about is it enough, not enough. The question, in fact, today is let's identify the technologies in which we are ready to invest. And frankly, if we need to put more, we will put more. It's not a question of $10 million for corporations like Total, BP, or Chevron. I mean, it's not that story. So the question is more, and in fact, when you speak about CCUS, you don't have so many initiatives around the world. And we are identifying and trying to participate. There are also some companies like ourselves, together with Equinor and Shell, who are investing in a project in Norway. So it's not either OGCI or the companies. It's a joint platform in which we leverage. And frankly, I can tell you this commitment on methane 1 year ago, without the commitment of the 10 CEOs around the table, we would never have been able to frame it and to express it. No, it's done. And when we are committed to something, we'll do it together. And it's done at an ambitious level. So I think it's, but of course, at the same time, each company has its own strategy and develop it. And I will not ask, by the way, I don't want them to copy me. You know, I'm fine to be my low carbon electricity. I prefer only 1 or 2 to copy me and be original, you know. Up to each company to do its strategy there. But I think it's not enough, but I think it's maybe not enough, but it's better to have it rather than not to have it. And I think I've been very surprised, by the way. Generally, the OGCI event is done in London, the first of 3. This time, we decided to do it in New York. I can tell you the feedback from the people there in New York was much more positive than in Europe. Because in the US, the oil and gas industry is considered as being able to deliver some prosperity, I would say. It's part of the prosperity case. In Europe, there is a debate about it. And so I can tell you that there, the welcome by the US stakeholders, and we were in a room with many of the NGOs, many of the people who are today, was welcoming us in a very positive way. So I think we should also have the eyes of both Atlantic, and sometimes I will suggest to my colleagues, by the way, to do the annual event in New York. It's better on the other side. At least we are welcome, you know.
Can you hear me? Yes. You mentioned you're complying with sanctions. As you know, complying with sanctions takes a bit of planning. Have you stopped buying Iranian oil since it's coming very soon?
But we have stopped already because, you know, there is no way to buy any crude oil because you don't find a single bank today to trade crude oil.
What was the replacement?
So it stopped since July. I will tell you in total. There is even if we had the right to do it until November. And we had the contract, but we are unable to put it. There was no more banks ready to make transaction with Iran. We did not find them, and the one which continued refused to take new customers. You know, so we stopped. We stopped.
What was the replacement?
You know, oil. There is enough oil in the market. You know, by the way. So you have oil. I don't know, probably Saudi Arabia, probably Urals, and you know, like we were doing before. In 2015, you know, and you know that this will have some impact, clearly, I think, on some of the crudes will benefit from that. The Urals should benefit, but in the meantime, the Russians have also built their pipeline towards China, so it has to be checked. But there is enough oil in the market, you know, so it's more a question then of what is the price of it, and the value, which could have an impact on the profitability of the refineries, European refineries.
Thank you.
Thank you very much, Ron Busso from Reuters. I want to ask you a question which I haven't heard so far today, which is surprising. Oil is at $85. How does that, and obviously oil majors like Total are generating quite a lot of cash flow these days. How does that, if at all, changes your capital allocation plans in terms of FIDs? Are you a bit more confident now to press the button on more projects?
No, it's not because I have a screen at 85. I change the strategy every morning when I wake up. You know, it's no. It's better to be at 85 than at 50. I'm more comfortable. That's clear. And I prefer to have the headaches of allocation of capital, but I have a problem of headache of scarcity of capital. That's very clear. But no, By the way, for Total, you know, strategy is clear. Today, the focus is to sanction projects, and we have a bunch of projects. We have identified 25 of them. We need to sanction them. It's absolute priority. We have spent quite a lot of activity to accumulate some reserves and resources at a low cost during the last 3 years. Now it's time to put that into action. There is no problem because we are entering into a period where the legacy capex that we had from the project sanctioned in 2013-14 are going down because we put into production all these projects. By the way, it's why we have a growth of 6-7% per year during the next 3 years. So in fact, these legacy capex are disappearing, and so we have plenty of space, even with $15-70 billion to sanction projects. So there is no problem at all of allocation of capital. The priority is clear. We want to do it now because the costs are low. I think we will remain low at the international scene for quite a long time. And I would like just make 2 comments. I will take this tribune to tell you why. People just want to believe that it will happen today like it was happening in 2005, where we've seen a big inflation from 2005 to 2008. There are 2 fundamental points which have changed. In 2005, the industry was coming out of a period of 20 years with very low capex. Mm-hmm. So the capacities in the service industry were at the minimum. Since 2005, today, it's not at all the case. The capacities in the service industry are not at all at the minimum because between 5 and 15, they have built some capacities. And in fact, today, you have 40% in most of the markets. I speak about, again, outside of the US onshore. I am in international oil and gas. The capacities of the service industry are unused at least for 40%. So you don't have it at all in 2018, the problem of capacity we had in 2005. So the first point. The second point is that by that time, when you observe where the inflation was coming from, it was not coming from big increase of capex of national companies, of major companies. The big increase of capex was coming from the independents, the middle-sized companies. These companies are much more flexible to the oil price to invest capex or to go from 0 to 10. Or these companies there was a fundamental shift between 2005 and today. The US independents, which were the core of these middle-sized companies, have shifted their strategy to US onshore. They are no more in the international oil and gas business. And so, before to see, so this was the two drivers of the inflation: lack of capacity from the service industry and a lot of activity from many independents. Today, in the international oil and gas business, these two factors are very different. So the inflation is not there. I'm not expecting it to come back quickly. And it's why, again, the strategy is to sanction projects to benefit from these low-cost capex, so that the next wave of growth for Total will be a low-cost base in a capital employed. And so today, the motto in the company is let's sanction these projects.
Right. And with that, we are out of time, so please join me in.
One question.
Oh, are you okay to take it?
David Shepard from the Financial Times. I'll ask it before we
it's
have a
very
chance.
frustrating, you know.
I'm not sure you'll like it. But,
if I don't like it, I have the right not to answer.
my question for you is whether, with the lack of investment there has been since 2014, are we now heading for a supply gap? I mean, I look at spare capacity, it's close to zero if you speak to some executives.
I like the question, in fact. It's one of the, it's obvious, but after 15, 16, 17, 18, and you will see 19, because I don't expect much increase of the capex in 19 because the companies will still be prudent. 20, maybe if we remain at 85, you know, people will forget. But a low activity on sanctioning projects, the impacts obviously will have impacts on the capacity on the world, at the world level, 3-4 years after. So I think there is one fundamental factor which supports higher prices, which is this lack of sanctioned projects. You know, I gave a statistic last year. We have sanctioned an average of 10, 15 oil projects per year instead of 35, I think. So something will miss somewhere. Okay, you have the shale oil, which is probably will fill part of the gap. And there is for me an unknown, which is of large can the shale oil fill this gap. But on the conventional oil, yes, there will be a lack of capacity coming on stream. There is no miracle, you know, if you don't launch projects, if you don't invest, and unfortunately, the way to accelerate is not so obvious. Of course, we have some short cycle capex we will mobilize, but that will not fill the full gap. So this is a fundamental. This is supporting higher prices. On the other side, you have the shale oil, and that the experts of shale oil, which I'm not, are better positioned than me to answer to you.
Should consumers then steel themselves for a prolonged period of higher prices? Should consumers then steel themselves for a prolonged period of higher prices?
No, be careful. I think it will be... I remind you that in this room, I think there were plenty of experts explaining last year that there was a ceiling in the market at $60 because of shale oil. I never believe in any ceiling nor any floor. I will begin to hear today that there is somewhere a floor, I don't know where. No, I think there is a huge... I think, let's be clear. Today, the market is well supplied. It's well supplied. And by the way, the gasoline inventories are continuing to grow despite the driving season. If the price is high, it's not a question of supply and demand. It's fundamentally because of geopolitical factors. Each tweet, price is going up. That's good. That's all. That's all. And why? Because people are worried, because the market begins to think that maybe it's not 1 million barrels of oil per day which will be put out because of Iran ban, but it could be 1.5 or more, and because the sanctions are being really tough. So today you have nervosity, and that if that conflicts develop, you don't know what it could happen. We have heard a leader of Iran saying that if they cannot export, others will not be exported from the Gulf. What does it mean? So I think today you have fundamentally this price. It was 1 year ago, it's surprising, there was no geopolitics at all in the price, you know, even it was surprising sometimes. But today you have, you have this anticipation that geopolitics could disrupt the supply. So let's see. So it's why we have to be, because maybe there is a deal somewhere which is taking place, and suddenly geopolitics will become very quiet. Price will go down. I don't believe, but we'll see.
All right. So with
Thank
that,
you.
please
Thank
join
you.
me in thanking Patrick.